What we need to do better at is keeping people engaged and educating them on what their options are. Like most people don't even know if they can use their IRA to invest with us.
Right.
And so many people have their minds blown when I'm like, yeah, you can just take your IRA money, carve out some of it, and we'll put it into real estate for you.
Yeah.
This is Directly Invested for investors who want more than spreadsheets and speculation. No hype, just honest conversations to help you invest with purpose. This podcast is brought to you by Tamarack Capital.
Everybody, welcome. I'm Tori here along with Casey. Excited about this episode that we have for you today because it's something that comes up a lot, even with seasoned investors, but not everybody really knows exactly what syndicated real estate is and syndicated multifamily real estate. Excited to talk about the basics of syndication.
Absolutely. Yeah. And this is, it's a great topic for us to hit on and get into, what is syndications. We live and breathe it every day. And so even dealing with, pretty seasoned investors, we assume that they know what syndications are, but a lot of times I get some blank stares. And so I think really just hitting the foundational 101 topic of what is real estate syndication is a really good thing to do.
Yeah, no, I agree. I think that that's one thing that sometimes, Casey, I think I have to remind you is, hey, not everybody even understands what syndication is yet. Let's make sure we educate them.
Yeah.
Because Casey's often thinking well beyond syndication, but in tax benefits and other things that come along with it, which are all very important. So this will be a great introduction to basically what is syndication. So let's just dive into that question. Ultimately, what is syndication? Like, what is it in the real estate world, and why was the word used to describe this type of investing?
Yeah. So it's kind of a industry term that I think is a bit specialized here, but basically a syndication is a group of investors coming together with the goal of buying an asset and benefiting from that asset. And generally how we see syndication structured is that there's two groups involved. There's the general partners and the limited partners.
Okay.
Limited partners are any investors who want to have the economic benefits of this investment, but don't have the time or expertise or network to really execute, acquire the asset and execute on it.
Yeah.
The general partners are the people who are us. We do this full time. We have the network of brokers, lenders, and investors where we can bring all these parties together to identify a project, underwrite it and vet it to make sure that it fits all of our criteria, and ultimately raise the money to acquire it and then go operate the business plan to make the investors their returns.
So in a little bit, we'll go over exactly what the role of the general partner is, which I'm excited to get into. But before that, let's talk about what syndication isn't. So how is it different then? Because more and more of this is coming online now where people start to understand real estate and that they should be investing in it, which is crowdfunding for real estate.
Mm-hmm.
And also just a traditional REIT. What is the difference? What are the benefits, or why would you invest in syndication rather than going to these other routes? I mean, I've even seen some new ones that are funds that you're just buying shares of, which I don't know how that's different than a REIT, but it seems like they're at least marketing it like it's different than a REIT.
Yeah. Well, let's start with maybe the most simplest ways, because there's a lot of different ways to get exposure to real estate. And so depending on your constraints, will probably inform what strategy you want. So if we look at it real basic, if you have more time and life flexibility, like you can move, than you do have just straight up capital, then you might want to do something where you go buy a duplex or a fourplex to go live in. You can get great financing with low money down. You can even move every couple of years and build a portfolio that way.
So you're the only person on the cap table. You're doing all the work.
Yep.
But you have all the upside too.
Exactly. So you're just straight up just like you're buying your own small investment properties.
Okay.
And that's great for someone who doesn't have a lot of money, but they're willing to move, right? As you move and progress through your life, maybe you start having less time available, or you have a family, you don't want to uproot them and move every year.
Yeah.
And so now your options are, they change. And so maybe it's more, you want to pool some money together with some other partners, and you guys all throw in $100,000 or $250,000 and you go buy an apartment complex. And you guys are also involved on managing this.
Mm-hmm.
This is great if you got a bit of money, and you also have the time to manage it, because these things do take some effort. But and you also want to learn how to do this. You want to get your hands dirty, and you have partners who can contribute different skills or experience into doing this. And so this is great for someone who has the money, but also wants to be directly involved, and whether for, just building their own experience or they have the pride of it, um, that's a great option too. But then what we really tailor our offerings to are people who have more money than time. They're not going to move,
Mhm.
and they don't want to be involved in the day to day. They want to have operators like us that they trust, they know, they like. They want to write $100,000, $500,000 check, get the exposure economically to these assets, but then that's all they do. They just read the quarterly reports, and that's their involvement. So
Yeah, it's interesting because I think it's great too for people. You can kind of skip the process of learning about managing a duplex and then managing a fourplex and then an apartment complex and just go to, I want the benefits of a larger asset class.
right.
I don't want to deal with that. Um, and I don't have to feel bad about that either. But my role is to be an LP. My role is to be a limited partner and to contribute the money and get the benefits of a larger asset class and stable investment.
Exactly. Their time is best spent on their core competency, whether they're a doctor, uh, W-2 professional, business owner.
So let's talk then. Let's move on to talk about the relationship between GPs and LPs. So we have the general partners and the limited partners in a project like this. So overall, just top level, like how would you describe what's the biggest difference between an LP and a GP in a syndication?
Yeah, it's kind of in the name.
Hmm.
And so limited partners are very simple to understand. They're limited partners. They're just there to write a check and get exposure to that investment.
So they're limited in the management and say they have or the say they have in the management. Like they can always reach out to us and talk to us,
Oh,
but
absolutely.
they don't run it, they don't operate it, they don't.
They're limited in every sense of the word. They don't have any management responsibilities or burdens. They're not guaranteeing the debt, so they have limited exposure on that.
Positive.
Right. Their investment risk is the money they put into it.
Okay.
Versus us as general partners, we have recourse on the debt, so we personally guarantee it. So if this project fails, the lenders can come after our personal collateralized assets. Likewise, if there's a lawsuit on the property, limited partners have zero exposure to that, whereas we could potentially be sued as general partners if we're found to do severe wrongdoing. And so there's a lot of advantages in being a limited partner if you just want your risk exposure to be limited to the money you write into that.
Yeah, that makes sense. Let's talk a little bit then about the more detailed part of being a GP. What is it? And we're going to kind of get into the nitty gritty, but not in full detail. But so from the very start, let's talk about like deal sourcing, because that's one thing I think is a little bit invisible because most of our clients that have invested, they don't actually see anything until we've already gone through underwriting and determined,
Yeah.
well, at least early underwriting to determine whether we even want to make an offer.
So this is a very underappreciated aspect of structuring the deals. When I first got into this business, I kind of done some small multifamily and some commercial properties, but I did not have a very good broker network.
Mhm.
And one of my tough moments of truth was you get in there and you say, hey, I want to buy this type of property, but they're not going to bring those deals to you at first, because what's a broker trying to accomplish?
Yeah, they want to close.
They want to close with high confidence of closing, and they want to do it quickly. And so they look for their network of buyers who have a track record of coming up with the capital, knowing how to negotiate and navigate the due diligence and feasibility period, because something always comes up that throws you through a loop, and you got to figure out how to be a problem solver collaboratively. So there's a lot of closing on apartments actually pretty challenging, and they look for the guys who have the proven track record. So coming in just off the street, even if you have millions of dollars, it might be difficult to source a deal without having someone with a bit of a reputation in there for performance.
Yeah. So that brings us into the second part of that, which I would call underwriting and due diligence, which is that process of trying to figure out. So when they market the property, there's marketing in that. In other words, there's a truth to everything they're telling you when it comes to the documents they're giving you, but there's also a role that we have, which is to uncover the real truth behind it all, and also to make our own assumptions about and risk profile and trying to understand that. So tell us a little bit about that, about underwriting and due diligence.
Mm-hmm. Well, first of all, we generally focus on a investment strategy called value add.
Mm-hmm.
And that means that we're going to acquire properties where we know we can come in and add value to them through generally renovations, making units nicer, maybe update the landscape and exterior. But through these investments, we can get the rental income up, which boosts the profitability of the building, and the net operating income, which is basically the profit of the building, is the primary driver of that building's value. So if we can increase that by 10%, we'll increase the value by 10%. So we have multiple layers that we go through on underwriting. First is looking at the current as-is financials, pairing that with what's our debt going to be to service that acquisition, and how close are we away from breaking even, or what's our anticipated cash flow. Then we also look at what kind of improvements we need to be making. So we're putting in $8,000, $15,000 a unit. And with that investment, what do we think we can get rents up to? What does the market support? So we're putting in a few different dimensions in here that ultimately results in the entire investment return profile. And the brokers do try and give you that first guess of, hey, put in this amount of money. This is market rents. But also their job is not to get our investors the return. Their job is to sell that property. So they might be sugarcoating some assumptions or be a little rosy.
Yeah, for sure. So from there, if we're talking about a syndication, we move into where the underwriting and the due diligence initially appears like, hey, this is good. We're going to put an offer in, and it's accepted. Then we move into the private capital interest stage, which is basically, okay, let's go figure out who might be interested in this. And that's typically then when we reach out to our investors, which are probably watching right now.
Yeah.
And so tell me what that looks like. How do we describe it to them? How do we present a property when it gets to that stage?
Yeah. So we put together essentially a overall investment summary deck that looks at the opportunity, the market, the execution plan, what kind of renovations. We try and give them all the key information they need. One of the things that we're evolving on is trying to engage with our investor network and identify those who are actively looking for adding real estate to their portfolio. So we can start engaging with them, educating on the strategy, keeping them posted on upcoming opportunities before we even get that property under contract to buy.
Yeah, it's a good point, because if we talk to somebody, I know if I talk to somebody, I know I've seen you do it. We're always trying to gauge their interest in, are you ready to invest now? Like, are you? And the reason for that isn't because we're trying to make a hard sell. It's because once we have something under contract, it has to move fast. Like, we have to get it.
Right.
We have to get the cash and get it closed. And so there's a limited opportunity and a limited time there that we have to get that all to happen, which leads us into the financing part. Which
can I hit on that real quick too? So out of all of our investors, I would estimate that maybe 20% of them at any time are like, yeah, I got the 50, 100K, I'm ready to go when you get a deal. The vast majority of them are real estate curious, or the timing's not right now. Maybe they're going through a certain life situation, or they're moving into a new house, or whatever it is. They're like, yeah, keep me in the loop. I want to be involved, but this year's not the year. And so it's really trying to understand how warm are they ready to go, just so we can all work together a bit more collaboratively.
Yeah, and I'd say that's always a good reason to talk to us, because if you know that we're not in a situation where the only people we want to talk to are those that want to invest in the next 3 months. We want to know what your goals are. We want to know where you're at. And always to find if that opportunity is right for you at a given time, and to stay connected with you. So I think that's always going to be important as far as Tamarack goes.
And one of the things that we can and will be doing better on is, like we said earlier, we live and breathe this stuff every day. I personally believe that everyone should have some real estate in their investment portfolio, just from a diversification and to get the benefits of it. What we need to do better at is keeping people engaged and educating them on what their options are. Like, most people don't even know that they can use their IRA to invest with us.
Right.
So many people have their minds blown where I'm like, yeah, you can just take your IRA money, carve out some of it, and we'll put it into real estate for you.
Yeah.
And so just kind of helping them along that journey, like, even if you're not ready or don't think you're ready, just having that conversation, looping in with our educational materials, I think is a really fun part of the job.
So part of our job as GP is to secure financing. Can you just give us a quick overview? Like, what does that entail? What does it look like? What is the process like behind the scenes as we go to try and secure financing for a deal?
So we work with one of our preferred mortgage lender brokers. And so they have relationships with some key credit unions and banks. And what's complicated about commercial lending, as opposed to like buying a house with a mortgage, is that these are not generally not, unless you have agency debt, government-backed loans. And lenders have both self-imposed and regulatory restrictions. So regulatory, they might not be allowed to have more than a certain percentage of their total balance sheet lent out to a single operator like us, right? So we have some lenders that we really like, but we've already maxed out, they can only have $6 million lent out to us, right?
So you're not even referring to an individual deal size. You mean that even if you have multiple deals, it's just aggregate. Like they'll aggregate it up and
Yeah.
say, we can't give you enough
You have
loan.
too much exposure to Tamarack
Okay.
Capital, right? So that's one complication. Additionally, the executive teams at these banks or credit unions are constantly kind of reevaluating their own portfolio allocation and what their goals are. So this is kind of a long roundabout way of saying you can't just have a key relationship with one credit union or one bank, because they might be overexposed to you, and their goals are changing quarter to quarter as the board wants them to have different target allocations. So we work with a lender who has a lot of different relationships and can shop our deal around to find which lender has money they want to lend out to our type of strategy, and we can kind of find a fit in there. So that's step one. The banks underwrite, obviously, the deal, and then also the operators. So I'll start with the operators. They underwrite us both from what's our track record and our ability to execute. Just like with the brokers, they don't want to go with an unproven person.
Mm-hmm.
The lenders also want to know that you have experience in what you're doing, you know how to execute, you have a track record. Additionally, they want to know you also have a strong balance sheet. So this is a pretty big barrier to entry, where you can't go in there and get a $5 million loan if you have a net worth of, $100,000. And so I think we're fortunate in that we are able to self-back the deals. But oftentimes you'll see syndicators who might not have the personal balance sheets to do this bring in a balance sheet partner who is a general partner now, only for the reason of signing on the loan.
I was about to say, like, I know, knowing some of our investors in the previous deals, I think there's some balance sheets we wish we had, right? So, I mean, I don't want that to have anybody to think that you have to have a certain balance sheet just to invest with us. But that's the whole point of syndication, is you have people all across the spectrum, from very early real estate investors to people that invest with us that have done their own real estate deals at times. So I think that's pretty cool about it, and an interesting part. So let's do a really simple deal. Let's just call it $10 million. We're going to be secure financing. We get through. A typical cash that we would need to bring to closing at that would be what?
Yeah, we're generally all in between our acquisition price and then the improvement budget. On $10 million, we'd be bringing in about 35% of the equity. So we'd leverage 65%.
Okay. So that's 3.5 million. And then we're going to go out and we're either going to have some GP money put in with that. There could be. And then whatever's left over, we're going to say that's what the LP, that's what we're going to try and get people to come in and invest with.
Right.
So that's the money we're trying to raise, is that 3.5 million.
Right. And so let's look at that example of 3.5 million. So the GPs can also and should co-invest their in their own deals, right? So when we do that, let's just say that we're putting in 500,000. We're putting that 500,000 in as LPs. So in our own deal, we'll be both the general partners and we'll have limited partnership ownership because we invested that $500,000.
Okay. Yeah, that makes sense. So then if this all works out great, we get the LPs to come in and we get it funded, we move to closing. And any details about closing you think would be worthwhile to share?
It's a big topic.
Yeah.
It's a very stressful time. So generally what happens is, let's just say day one, we get the property under contract. You'll generally see about 30 to 45 days of feasibility. And this is where, you make assumptions in your underwriting to make an offer, right? But you can't know everything before you submit that offer, because of time and just the amount of time before the offer and the amount of time it takes to go in and do that due diligence. So you have a period where we're walking all the units, we're talking with contractors to get the budgets lined up, we're talking with our property management to really nail down our rental assumptions and make sure that we can stand behind them. And at the same time, we're also moving forward with the financing and we're dealing with our investors. So we're dealing with the property, we're dealing with our lenders, we're dealing with our investors. And during that feasibility period, we need to know and get go from soft commits to firm commitments from our investors, because we want to make sure that we have the equity lined up and ready to go, I'll step back and say there's this thing called earnest money, right? You do it with whether you buy a single family house or you buy an apartment. On a $10 million deal, we'll put up $150,000, $200,000 of earnest money that's fully refundable during that feasibility period. But then once we waive feasibility, that money goes hard. And if we don't close, we lose it. And the general partners are putting that money up. So we have our own money on the line here. And that's why we're in, pretty much a period where if we're calling you a lot because you expressed interest and, you want to come in, we got to know, we have to have a high degree of confidence before we put our money, earnest money hard.
Yeah. That would make sense. So let's say all that works out great. The deal is closed, which is good for everybody, both the GPs and the LPs, especially on the value add side. That's when we start executing really on the business plan that we've laid out, which is typically what, if we're looking at like a value add property. I know it can vary, but maybe give some scenarios of what could be a business plan that we start, mainly on the improvement side, but anything else you think that might be relevant.
Yeah. So stepping back, we generally expect these deals to have about a 5-year life cycle, right? And each deal is different, but we call them the light value add. These are more cosmetic things. So when you go into a unit, you're just new paint, new carpet or flooring, maybe some new fixtures, but nothing very intensive.
I think you're going down the right path here. Like, what are things? So, like, what would we start executing? What would we do? And one of these would be, like you just said, kind of like a really light flip. Like if you were talking about a regular home, which is, we're going to make it look better. It had overgrown foliage, it had all this stuff that we came in and cleaned up. But others are more intensive, and some of those we have right now that require more upgrades than just cosmetic.
Our job really as a GPs is to be problem solvers for both the seller and for our investors. We look at each deal and there's the cosmetic light value adds, pretty well understood and well-worn playbook. We also get in situations where there might be more extensive problems with the property, either extreme deferred maintenance. We have our last project was 102 units in Pullman, Washington that had some units that were empty during the winter, and we had a deep freeze. The heat was turned off and we had pipes burst because it got frozen. Now we're going in and we're opening up a lot more walls. We're redoing plumbing, and it's not just the physical damage that we're addressing. The properties also start taking on their own culture. So you can imagine you start having some properties or units that flood. Well, that's going to cascade down into the lower units. Now you're starting to move people out. We bought one of these apartments with 40% vacancy, 40% occupancy. So 60% of the units were vacant. What does that do for the culture of a property? You start having people just move out because there's issues, poor management, maybe some squatters come in, maybe some unsavory characters come in, and there's higher drug use. And that just creates a cycle in there where now our problem is not just replacing plumbing, but also rehabilitating the feeling and the culture of that apartment.
Sure. Yeah. So all of this, executing the business plan, I know what we're trying to get to is what we call stabilized, which is our rents are higher, the culture is different, the property itself now is a performing property, and it may actually have been performing the whole time. It's not performing to its max potential.
Right.
And so that's what is that stabilization period? What is it? How long might it take typically? I know it's probably different, but when you're looking at it, what would be like your ideal? Like, I would love to get it stabilized in 2 years, or how long does it take?
Ideally as fast as possible. The fastest I've seen is about a year, but that is extremely fast because you have to think you're turning every unit, you're rehabbing every unit, and you're not going to have people move out every year. And so it's a combination of trying to raise rents up to market rents while also managing your vacancies. Generally 2 years is about the sweet spot. Longer than that, I think that there's some other challenges in there that you're dealing with. And then we look at about a 3-year stabilization period where we hold it. If things go well, maybe we sell it after, year 3 or year 4, but we try and set the expectations that we'll have a 2-year stabilization period or rehab period and then hold for about 3 years.
And then, our job obviously throughout this too is investor relations and reporting on what's going on, because, people have invested their money, they have it in this property. They don't know what we know every day.
Yeah.
what are the questions you get the most, and what do people most want to know about these properties once they're invested in them?
The first 2 years while we're going through the rehab period is really where it's the highest risk of the investment.
Mhm.
People want to know how progress is going. Are we hitting budget, timeline of the rehab? And then once we get the turned units, are we hitting market rents? If you can hit those 3 things, you're pretty much covering just about everything you need to cover on that. And so that's what our reporting covers for those first 2 years during the rehab
Progress
period.
on those things.
Are we on schedule for unit turns? Are we on budget? Are we on timeline? And then are we getting what we thought we'd get for rent?
And I know, Casey, that I've been, watching you. I don't take any of them currently, but you do take, calls from investors quite regularly too. So besides the standard reporting that you do, we do have investors that call and just want to know, hey, like, kind of like what's up or what's going on. And you typically take those calls and are happy to give them an update.
Mhm.
Yeah. So that leads to exit, really. So after all of this, and you just mentioned it, in our book, in our ebook, we talk about 3 to 7 years, but I know that 3 is pretty fast, and we have some that are even longer than that. We have some that are projected to go out to 10 or 12. So it's pretty open,
That's a
but
pretty
not
unique,
typical.
yeah.
Yeah, it's not typical, but that you as an investor, you would know what the target is like when you invest.
Exactly. So let's hit on that 12-year one. That's a very unique business model where we bought these apartments under a low-income housing program called Section 42, or the LIHTC program. It's an acronym. But pretty much it's generally a 40-year contract where there's tax credits at the beginning, and then you don't pay property tax during that 40-year period. But in exchange, you're actually holding rents at a certain amount below market rent to try and help the affordability for low-income tenants that have to qualify to live in your place. On this specific one, we underwrote it where this had the frozen pipes, and we believe that with such a steep discount that we came in on our purchase price, we could improve the units or get them back up to where they should be, get occupancy up, and then have a valuation that would support a cash out refi. And we're hoping to get our investors all their money back. We're expecting by the 5th year of ownership.
Okay.
Then we saw that the contract expired an additional 7 years after that, in which case we could then adjust those units up to market rent and get a very nice valuation increase. So this is why we had a very unique situation here of a 12-year hold period, because it was more about the contract expiring rather than any sort of execution we can do.
Yeah.
Yeah. Just look to get
And that close is always important because it's one of the bigger what we hope for is it's one of the bigger payouts of your investment is when you get to close and we exit out. So the close is always important. We do love deals that pay people, a regular dividend, cash on cash. That's an important part, but really what we're hoping for is to really raise the value and get a great close too. Like that's part of the upside of these properties.
Yeah, and I should hit on that. When we look at value add multifamily, it's probably one of the best investment strategies out there to make your dollar work as hard as possible. Meaning, if you put $1 into our investment, after that 5-year projected period, you should get the most number of dollars back. So maybe you can turn that $1 into $2.2, right?
Mm-hmm.
So your money works very hard on total returns, but it also has the downside of maybe a little bit less liquidity, cash on cash during that hold period. During the first 2 years, there really should be no distributions because you're
doing improvements.
Vacancy might be a little bit higher as you have construction crews going through there. So there's not a lot of like free cash flow to send back to investors. And then years, 3, 4, and 5, maybe there's 6, 8% is typically what we see for cash on cash. But it's less predictable. Maybe you have a bout of higher vacancy or some unexpected capital improvements you need to make.
Mm-hmm.
So when we look at this, the investment profile is really for anyone who wants to maximize their total projected return, and they don't care as much about distributions during that whole period. There should be plenty, but not as much as maybe an income fund or another vehicle that's more for predictable income.
Yeah, that makes sense. So let's move and talk to kind of the question of the upside, but also like why multifamily and why properties in the in the asset class that we talk about,
Mhm.
which, I don't actually know the floor of what Tamarack would invest in, but, I think right now at the stage we're at, we definitely want to be over 50 units. Would you say that, Casey? Or what is the number that you think we would like to be at for at least, and then go up from there?
50 is probably about right.
Mm.
I look at more from what's our total project size.
Mhm.
We're looking at 8 to 10 million a project. Is much smaller than that. It's not quite worth the administration and setup fees.
Yeah.
Um, when you look at multifamily, single family is just a single house, right?
Mhm.
Everyone knows that. Small multifamily is 2 to 4 units, and that's in its own bucket
Mhm.
because you still can get the Fannie Mae government financing on that, which 5% down, fixed year,
Mhm.
fixed rate for 30 years. So it's really debt driven from 2 to 4 units. Then you start getting into maybe small to medium sized multifamily, and that's like your 5 units up to 30, maybe 50. And those buyers are really mom and pop, or we talked about, a group of partners putting in
Sure.
some money each, right?
Yeah.
When you start getting above, 40, 50, 100, 200 units, you start getting into professional investors with data driven metrics around acquisition and valuations, right? And because our strategy depends on increasing the value, increasing NOI, we want to make sure that we're having a buyer pool that aligns with that valuation metric. So we see that at 50 and above.
Yeah, and that goes to the benefits, I would say, of these type of projects, which are larger multifamily. And you kind of touched on it, but why that instead of, we could also put a fund together that has 10 fourplexes or 20 fourplexes, but why these multifamily projects with the unit count that we think is advantageous at a price that we think makes it worth it to do it? In my mind, I'm thinking about, the reasons for it are, um, more reliable cash flow, the demand, is resilient, it's scalable, forced appreciation. There's so many different things that happen, as you work through this, that it's harder to accomplish when your unit count is too small.
I think a lot of it goes to margins and scalability. When you have, let's say we have 20 fourplexes, right? 80 units total. It's going to be rare that those are all going to be co-located on the same plot.
Hmm.
So you're looking at property management, they're running all around town just trying to manage these fourplexes.
Hmm.
So your property management expenses are going to be higher. Trying to get insurance across these things, you're not going to get scale or bargaining power, maintenance, roofs, all these things kind of compound in there where it's just not conducive for good margins and scalability.
So Casey, why don't you talk about the tax benefits? What are the tax benefits of, investing in a property like this under the syndication model?
Well, there's real estate's one of the most tax advantaged investments out there, unless you're owning like an oil field. But, and you bring up a really good point of why larger apartments are also great. So the IRS likes to facilitate and encourage people to invest in infrastructure like multifamily, right? And they do this by allowing us to do depreciation, which is where you can have paper loss by writing off fictitious expenses and just depreciating that asset every year, right? And so the IRS kind of assumes, like, let's just say on that $10 million property, 25% of that value might be the land. Dirt doesn't depreciate, so take out 2.5 million. So you have 7.5 million that you can depreciate. And the baseline is you can depreciate that over, I believe, 27 or 29 years. I forget which. So you get a little bit of depreciation every year. And generally that's enough to kind of cover cash flow. So you get some nice tax-free
Hmm.
cash flow, right? But it gets better than that because there's items inside these apartments that are going to depreciate faster than 27 years, right? Windows, appliances, flooring, fixtures. And so you can do what's called a cost segregation study, where there's multiple ways to do it, but generally the most regular way of doing it is you hire a engineering firm to come out. I think it's like $4,000 or $5,000, and they will walk through the property and they'll create a table of, out of that 7.5 million in value, how much is allocated to these different buckets. And some things you can depreciate over 5 years. Some are, 7.5, 10, 15 years, etc. And instead of depreciating that 7.5 million over 27 years, you can front load your expenses. So you get a lot of loss up front. And all that gets passed back to the limited partners. And so that's passive loss that can be applied to any sort of passive income. And it gets even better. We actually just had the administration pass their new tax bill where they brought back what's called 100% bonus depreciation. And this is a tax policy to really incentivize capital investment. And what that means is that you can take anything that depreciates 15 years or less and expense that day one. And so what we generally see on our apartments, and each deal is a little different, but out of that 7.5 million, you might have 2.5, 3 million in day one expenses. Now, if you apply leverage into that, the math roughly works out to, if you invest $100,000 with us, now that we have 100% bonus depreciation, you might get $100,000 in passive loss day one. So it's a huge advantage for people who are doing their tax planning.
Yeah. No, that's great. And so, yeah, we're talking about the benefits of multifamily. One of the things I think our job is always, and Casey, you always put this very well, but it's not our job to eliminate risk. It's our job, though, to evaluate it and understand it and know what risk we're taking, and then always share that also with our investors, which is what you call it is, and whatever, like, it's not like you're making this up, but the risk, what is the risk profile here? Like, what are we looking at and how to understand the risk? So let's talk about that, because I think everyone needs to know, look, it's real estate. There's risks with it, just like there's risk with any investment that you make. So what is it in multifamily? What things do we look at, or what influences multifamily the most when it comes to risk?
Risk is a complicated area, and I like to try and divide risk into multiple buckets, right? There's specific risk to the business plan, right? So if we're looking at, we're going to go in and maybe do a more intensive rehab. What if we open up a wall and we find some dry rot? Or, we had this apartment where a sewer line underneath the crawl space failed and we had to pump out 20,000 gallons of sewage, right? These are intrinsic risks to the property and the execution plan. And so you got to quantify it. We build in contingency. And then that risk also starts to get mitigated as we go through the project. So by the second, third year, we've gotten past that risk, right? There's also market risk or macroeconomic risk, right? So we're looking at specific to, one market we're buying apartments in. What's the risk of employers starting to leave that market? Are the jobs going to keep coming in and driving demand for our tenants, or could there be a recession and that affects these employers more materially and we start having more vacancy, right? There's interest rate risk. A lot of people back in 2020, 2021 were buying these apartments with low money down because lenders were getting a little fast and loose and they were putting, 15% down, thinking that over, it's on a bridge loan. So that loan, it only lasts for 2 years, but then they're like, okay, we're going to increase the value of the apartments. And then after 2 years, we'll get the value increased 20%. And now we'll just refinance in and not put more money in because we built up the equity. Well, if interest rates increase and prices go down, which is what we saw, that business model completely falls apart.
Mm-hmm.
So we try and control our interest rate, our interest rate risk with long-term debt. We build in lots of contingency, and we stress test our models to make sure that we can at least get a reasonable return if a lot of things go wrong.
Yeah, and unfortunately, I got to bring it up because I think we're trying to educate people. But another problem that's out there in the market is misaligned risk with whether you and the general partner, or if that general partner has the right intentions. That's kind of come up in the last few years because of people being in a little bit, some sponsors being in some trouble with some properties and fundraising maybe for not the right reasons. And so I think it's always good to really get to know your GPs, talk to them, have meetings with them, make sure you ask for all the right numbers. For the most part, somebody that's seasoned can dig that up and see if the property maybe isn't what they're saying it is. But for others, just asking questions and educating a little bit, knowing what to ask is probably a good idea for them.
Absolutely. I would also say that have an attorney look at the documents.
Mm-hmm.
Any operator or general partner worth their salt is going to have a very good legal package. But that's, there's this thing called the private placement memorandum, which is the document that calls out all the risks, any known conflicts of interest. And you got to read through this and understand it. You can also talk to your financial advisor. I would recommend the attorney much more so. Financial advisors, maybe they can identify how real estate can fit into your overall investment strategy. That said, we see a lot of times financial advisors, one, there's a misalignment of incentives there where they get their money through assets under management, and now you're trying to take money out of their AUM. But they have a good perspective that might be worth checking in.
All right, cool. So this content's been great so far. I think someone that's listening or watching right now would have a pretty good understanding of how these deals work. But let's talk about one thing that you brought up earlier that for sure I know people are often surprised by, and then also excited about when they understand that they can do it, which is funding this investment through your IRA, your self-directed IRA. So how does it work? What's it all about? How can they make it happen?
An IRA is simply a tax advantaged account that, if it's a traditional IRA, you're putting in pre-tax dollars, so you pay tax when you draw that money out. Everyone thinks that your IRA should go into some sort of index fund or bonds, but the reality is that the IRS doesn't care what you invest your IRA into, as long as it's not something like jewelry, fine art, car collection, vacation properties. There's disallowed transactions, but legitimate investments are absolutely encouraged. The only thing to do that is you need to have a self-directed IRA. And so just like how you might have your IRA with Vanguard to invest in different index funds, there's custodians out there is what they're called, that specialize in alternative investments. And we like Madison Trust. There's other great ones out there, but it's as simple as opening up an account with them, having Fidelity or Vanguard or whoever you're with transfer that IRA money over. And then you just work with your account manager to get the funds wired into your investment once the docs are signed. It's really that simple. And it's a great way to diversify your investment portfolios. If you don't have $50,000 or $100,000 in normal cash in your bank account, it's a great asset base to leverage. I would say there's one thing to be aware of is that you have potential for what's called unrelated business income, which occurs when you have an IRA that's leveraged, which real estate is generally leveraged. And talk to your CPA about this if you're concerned about it. But pretty much it just means that you might have your IRA pay a small tax liability when the investment is sold off for a profit, which I have my own IRA invested in real estate and not concerned about it, but it's something to be aware of and not get surprised by.
Yeah, so that's great. So basically, I think I would say the majority of the in the United States for sure, but I'm not sure how it works in other countries. But in the U.S., we're kind of just always taught, you work 9 to 5, you get a good job. Maybe you can even get a professional job where they contribute something to your 401k and you put money into it, which is great. But the mentality, I don't think is ever there that, hey, did you know you can do other things with that tax protected account or with that tax advantaged account? And so I think this is great information to know. Yeah, you can have a self-directed IRA. All right. So Casey, if someone's made it this far, I think they're probably, number one, a little bit more educated than they were when they started, but also they're wondering, okay, I'm interested. This seems like something I might want to do. What does that process look like? Like, what does it mean to say, okay, I'm more than interested. Now I want to figure out what is the next step for me to invest in a property through syndication?
My recommendation, if I was advising my parents, I would say, do some research and identify some different operators that have strategies that you think are intriguing and that also seem like people that you know, like, trust, maybe want to invest with. Vetting the operators is, I think, a really crucial point. And it can just easily start with reaching out to them, having a phone call. They interview you to see if you're a good fit for their offerings and vice versa. Do you think that they're a good fit to be, stewards of your investment? During that process as well, you're going to understand what their deal pipeline looks like. This isn't like trying to buy a unit of the S&P 500 where you can just go in and buy it in a day. These things, sometimes only 1 or 2 deals a year come along. Sometimes it's more frequent, but you can understand where they're at on their investor capital raise and their deal flow.
Yeah. And for sure, I think, one of the things I think that people should know is if you call us, we're just going to share information with you, and we're not going to ever hard sell you. We're not going to try and buy you, into the vacation club. This is about solving problems for you and actually wanting you to be in this deal with us as much as we want to do the deal. And I would say that's when we hit a win-win. So anytime we talk to you, we're just trying to align those goals. Are we aligned? Is this something that you're ready for and you want to do? And if so, cool. Let's get it done. That's one thing I do like about this asset class when it compares to others is the emotion hopefully is a bit removed from these transactions. Instead, it's just more about, is it the right time for you? Is the data right? Are we getting the property in the right way? Are we doing all of this? And so that's a great way to invest.
Yeah. And Tori, one of the first things we're going to do if you reach out to us is I want to know, what's your investment why? What are you looking for? Why are you even considering real estate?
Mm-hmm.
And if it's maybe your why is better suited for a different asset class or investment style, we can have that conversation. It's actually one of my favorite parts of the job is really having those conversations with people on a pretty, private part of their lives, but, forming that rapport and that trust to say, or can we help you out on your actual goals? Are you trying to get more current income, to travel more with your spouse? Are you trying to grow your asset base to pay for kids' college? Everybody has different goals, timelines, and that's the first thing we're going to do is how can we help you and can we help you? And if not, can we refer you to someone who maybe can do better to your goals?
Yeah. Well, look, today's been great. This is a great conversation. For you that are watching, if you think you might want to reach out and book one of those calls or talk to us, don't be afraid of that. Just book it. I'll put some links in the content section where you can reach out to us. But look forward to talking to you. If you do reach out, Casey, thank you. I think we did a pretty good job of laying out the basics of syndication today.
Hope so.
Yeah. Thanks.